It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the program, and with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
When you're heading into retirement, are there some areas of the investment universe that are more important than others? The retirement chapter of your life is one where you still need growth, but you also need to be paying attention to the risks along the way. So we're going to help you unpack which of the investment flavors that are out there are most important as you enter into retirement.
All right. Yep. We're hitting questions from fans of the show. That one's going to kick us off. We've got several others we're hoping to hit. If you have a question for the show, we'd love to hear from you. You can give us a call, send us a text, 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com. You can submit questions that way as well as you can also check out more information on the show or on the firm as well. Or you can find us online, social media, wherever you're at. Just search The Wise Money Show, and you can submit questions that way as well. So we're kicking off the show with a question from fan of the show, Jeff. Here's what he said. For people heading into retirement, are there certain funds or even specific sectors of the market that are less risky relative to the market as a whole? Got some money in a brokerage account I'd like to invest, but with reduced volatility. Historically, would this be the large cap value sector? Lots of depth to the question there, questions, but essentially it sort of boils down to, well, how should you invest when you're on the verge of retirement? If you're looking for growth, but you want that growth at less volatility and less drawdown, what should you do?
I feel baited by this question a little bit because you framed it as less volatile investments, but and that is how it was framed here by Jeff. But he also said just investments that are less risky. And I feel like as you're entering into retirement, big picture, everyone who's stepping into a new chapter of their life, you need to recognize, well, what are the risks that you're facing?
Yeah.
Yes.
And
define what that risk is.
Yeah. Volatility is the one that's kind of loud in your face. It's the one that scares people. The thought of their investments fluctuating throughout retirement, or worse, going down and just not bouncing back up, losing money in retirement. That's what scares people, right? That's what makes them nervous about the next chapter. And we often hear clients saying, man, as I enter into retirement, I don't have the ability to save more money, to contribute more money to make up for a decline in the market, or even take advantage of a decline in the market. And so you may have your mind, like Jeff's, pointed towards volatility of investments as public enemy number one. But I think we also need to stop and recognize that inflation is an enormous risk for you in retirement. Longevity, living longer than you ever intended or ever thought you would, ever imagined, is a risk to you in retirement. And both of those have implications on your investment portfolio. So an investment that deals with one risk and ignores others is maybe an error that you're making, or it's a potential trap that you could fall into.
It's hard to disconnect them, because the risk of volatility, when the market's going up, oh, great. But when the market's going down, all of a sudden people feel those other risks. Mm-hmm. Well, my investments are going down. I can't keep up with my purchasing power, right? My investments are going down. This money won't last as long as I need it to. So the knee-jerk reaction often is, no, I need less volatility. But by less volatility, that's sort of the analogy of the frog and the water pot, right? And well, it might feel better, but you've almost assured that you're not going to be able to keep up with inflation, mm-hmm. and that these dollars may not last as long as you need them to.
Yeah, when you think about safe and safety, that's really what people want. And so this is where you want to look at your streams of income, because that has a lot to do with how you should be invested. And as I think about this, I don't think your retirement, your investment strategy should change dramatically as you get close to retirement or as you retire. It should be being adjusted on an ongoing basis, and you should have the right blend of assets. And when people say safe, what is safe? And I did a little looking here. So the CPI over the last 10 years, and again, it just depends on what time frame you're looking at, but call it 28% or 2.8%. And you say, well, I want safe. And traditionally, people think safe as bonds.
Yeah.
So bonds, 17%.
Over the past 10 years.
Over the past 10 years.
Total.
S&P 500, 197%. Mm-hmm. So it's not even close. So the risk is not that the value of my portfolio went up and down. The risk is that the money supply increased at 8% per year. And so therefore, because even as I talk about streams of income, and people say, well, I've got Social Security, that's one of my streams of income. And even there's some talk right now about Social Security not being taxed. Listen, the cruelest tax of all is inflation. Mm-hmm. So people are like, well, I'm not going to pay federal income tax on my Social Security anymore. Well, that would be awesome, but it doesn't matter if the dollars that I get for Social Security only buy a fraction of what they used to be able to buy.
So here we go. I mean, we're painting the picture. Going back to a debate we had, and it wasn't even a debate, it's just a question several years ago on the show. Guys, what do you think the biggest single financial decision someone makes in their life? And I would have thought it was going to be maybe 3 bank account system, maybe some creative strategy, and Kevin just dropped the hammer. Thor's hammer. It's your investment allocation. And I thought about it for a moment, and it's like, no, yeah, you're right. Because your investment allocation determines whether you experience a 1.7% annualized rate of return over those past 10 years, really safe, but you couldn't keep up with purchasing power, or you experience some blend between that and the 100 and some percent cumulative return that the S&P 500 did because you had the right mix. So, Jeff, you've got to work with your certified financial planner. There isn't a holy grail of, well, if I can just go into this sector, then I'll get the upside with limited downside. You've got to look at your entire financial life and the risks that you need to overcome and have that drive, well, how should these dollars be connected to your entire portfolio to ensure that you're covering all risks?
Mm-hmm. You know, one of the dangers I think that a lot of retirees face, and this was almost conventional wisdom 40 years ago, that you invest in stocks while you're growing your retirement nest egg. When you get to retirement, move it into bonds, which are more of an income producer. They're not going to fluctuate as much, that sort of thing. And maybe that worked in a past generation because the interest rate environment cooperated more and we had a stable economy and all that. But in this day and age, if you're not paying attention to inflation and the erosion that it does to your spending power or your lifestyle, then you may go into a bunch of safe investments and you might safely become very poor.
Yep. Mm-hmm.
You're not experiencing any heartburn because of the stock market's ups and downs, but over time, you will feel your ability to just meet your basic needs in retirement just getting squeezed more and more and more. And it is a real thing. And I got to tell you, like, this is one of the most powerful things that a long career provides as far as perspective. When we've gotten to walk with clients for decades in retirement, we get to see the effects of inflation real time in their life. And those who position themselves to be able to grow their nest egg still in retirement to keep up with that spending, when you're meeting with your financial advisor and they say to you, or you say to them, listen, we're having a harder time meeting our basic needs. We need a pay raise.
Yeah.
We need more money coming out of our investments. That is feasible if that nest egg has continued to grow and you've put yourself in a position to be able to pull that off. But those who, kind of put it under a mattress, so to speak, or hold just a bunch of fixed investments that don't fluctuate and also don't really grow, man, every time life gets more expensive, every time the effects of inflation come to their house, they feel the effects and really can't respond.
So by wanting growth but at lower volatility, we're not talking, Jeff, adding more bonds. You asked, are there certain sectors of the market or even large cap value? We're going to get into that and more coming up on the Wise Money Show with Korhorn Financial Group. Thanks for being here. YouTube, this is the Wise Money Show. You're watching right now, our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern time every Saturday morning, and also on podcast at the same time, but also on a couple local radio stations where we're headquartered, Northern Indiana, Southern Michigan. And that's why the content's broken up the way that it is, with segments and the length that it is. It's a talk show. But also on this channel are Next Wise Step videos, 8, 10, 12 minutes long, taking one financial concept, applying it directly to your financial life, all so that you can apply wisdom to your finances, taking information and action, applying it at the right time, and so you can take your next wise step in your financial life. So if that sounds like what you need, make sure you hit that subscribe button, turn on notifications so you're aware every time we drop new content. And if you like the content, we appreciate it. Alrighty, so we don't need to spend too much time on it, riffed for too long. I was trying to get a reaction out of Kevin there. But because we sort of went round and round. But now, and again, we don't need to geek out on it too long. But let's answer the question, then we'll move on to the next one.
Okay, let's answer the question.
Yep. All right, here we go. If you're looking to invest with in stocks, but with a little less volatility, are there certain sectors or areas of the market that you should consider specifically as you're heading into retirement? We're answering that question and more. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com. Then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. Kicking off the show today with a question from Jeff, essentially saying he's near retirement, has some dollars in a brokerage account that he wants to invest, but he wants to invest in an area of the market that is less risky. Well, we spent a lot of time talking about, well, how do you define risk? You want to make sure that you still have growth, but yeah, if you're looking for less volatility, are there areas of the market? What I'm looking at right in front of me is a chart from JP Morgan Chase. They update this, a slide deck called Guide to the Market. It's really interesting if you like to geek out on these sorts of things. And it breaks down the 10 different sectors of the market. By the way, large cap value is an asset class, not a sector. Sorry, it's kind of complicated. But there's 10 different sectors: energy, materials, finances, consumer staples, discretionaries, utilities, that sort of thing. Well, and it compares the return and the risk of those to the S&P 500. Well, the ones with the lowest beta, the lowest risk compared to the S&P 500, utilities, technically half. I don't know what time period this is looking at. Usually beta is measured over 3 years. But about half the risk, utilities half the risk of the S&P 500, and about half the return as well. So that sort of answers your question. Are there some sectors that are less volatile? Yeah, but you're going to give up a significant amount of return as well. Instead, what I would consider is ensuring that you're diversified and that you have done the stress testing on your overall portfolio. Maybe you should consider some hedging as well, where you're giving up some upside because there's a cost to hedging, but your participation rate is much greater than half of the overall market. And the volatility or that downside risk is much more calculated. It's much more measured. And that may be because there's certainly been times when utilities, even though I can say mathematically that over this time period, the risk is half, certainly time periods where it's going to significantly underperform the S&P 500 or drop significantly when the S&P 500 is going up.
Yeah, there are statistical measures where you can measure volatility, but I don't know that that's terribly helpful. When you look at large cap value and you say, so large stocks, when you think about large stocks, what are we even talking about here? You're talking about well-established companies that have a track record and you know what's going on versus a mid cap or a small cap stock. And so you say, well, I like the large cap stocks, just give me the large cap stocks. Well, what happens when there's a rotation out of the large cap stocks, which there was, and small caps in July of this year went up 9% compared to the S&P 500 going up 2%. And so you say, if you're constantly chasing, you're never going to get there, and you're always going to be late to the party because of the algorithmic trading that happens and the institutions that use 10-to-1 leverage and all these types of things. So I would encourage you to say what asset classes, and then to Mike's point, within those asset classes, are there certain sectors that I want to be invested in? But if you've accumulated a certain volume of money, the question is, do I want to spend through this money by the time I die, or do I want to keep my principal intact and only spend the growth on this money? Because those are two different approaches, which would influence how your investments are structured.
Mm-hmm. Would you guys say pretty definitively, though, that for most people, when they're entering into retirement, unless you know something about your life expectancy, based on health issues or something like that, retirement is going to be measured in decades for a lot of people, not years.
You should assume that.
That's
absolutely.
Right. So it's a long time horizon, which means you have to have growth-oriented investments. And to me, that means you need to have a portfolio. Your nest egg needs to be heavier in the stock market. The stock market may sound like a scary place, but maybe instead of calling it the stock market, you need to think of yourself as, I'm going to be a partner in some world-class businesses, right? These are businesses that have been around often for decades and should be around for decades out in the future. They're providing real, valuable services, valuable products that people need or want in life. And so they may fluctuate in value, but the economic impact and the necessity of them being around is strong, right? Like these businesses, we need them. Mm-hmm. And so to me, fluctuations aren't what you have to be concerned about. It's more about, am I an owner of assets that will go up in value over time and can help insulate me from inflation? If so, to me, often those are stock type investments. Those are business type assets that you need to own, even in retirement.
Yeah, and I wouldn't just isolate large cap value. When you look at the beta of large cap value compared to the overall S&P 500, that is a risk premium. That's a risk area where in recessionary times and drawdowns in the market, large cap value you'll often see go down worse than the S&P 500. So,
and just being a jargon-free zone, beta.
Yeah.
Go ahead.
Is beta. It's
Sounds very
is risk relative to another asset class. So beta meaning risk relative to the overall S&P 500 and so on. Okay, I'm going to add on to that. Next question from another fan of the show. How can we know which part of our portfolio to spend first? You draw down your traditional IRA, your Roth IRA, and I want to couple this one next to Jeff's question because sometimes this decision influences how you should invest. Jeff was saying, I've got my brokerage account. I've got money in my brokerage account. Should I invest it in large cap value? Well, are those dollars in your brokerage account going to be the ones that you draw out first in retirement? Mm-hmm. You mentioned you're close to retirement, Jeff. Don't know how soon that is. If you're thinking you might be drawing those dollars out in the short term, I actually might not have those in stocks. But let's add on this question in the show. How do you know which part of your portfolio to spend first?
Yeah, you're pointing to the fact that liquidity is going to be one of the most important things that you manage in retirement. When do you access the dollars that you've been building and accumulating in your retirement nest egg? And some of those assets are going to be fluctuating in value, regardless of what type of an account they're in. And obviously, you don't want to be selling things that are at depressed prices just because you got to buy milk or buy Christmas presents or pay the bills, so to speak, in retirement. So to me, making sure that you have access to investments that are easily accessible without selling at a depressed price. They're not fluctuating too much. And to me, this is a question of, well, am I past age 59 and a half when I retire? If I am, then I've got all my retirement nest eggs available to me, all my retirement tax shelters, like your IRA or your Roth IRA. If you're retiring early, you may want to have access to some dollars that have no rules attached to them, things like a brokerage account or a trust account. Maybe you have a joint account. These are accounts that don't have a tax shelter to them, but you have maximum flexibility, maximum accessibility to the money. So to me, this is partially a question of, well, what age are you when you're retiring, and what is your tax picture going to be from each of those tax shelters?
Rule of thumb, though, not that you live by rules of thumb, but you want to spend the Roth IRA dollars last, right? Because you want to have those dollars growing tax-free for you as long as possible. And
Right.
if there happen to be dollars left over after you're done with them, your kids or the next generation inheriting the Roth IRA, we now know there's clarity from the IRS. They've got 10 years to draw out any retirement dollars. Your kids would, and they've got to take a required distribution every single year if you've already started your required distributions. So inheriting a Roth IRA is much better. So you've got to be doing the ongoing tax planning. So maybe you'll draw a little bit out of the Roth here or there, but given the choice, drawing from non-IRA accounts first, or non-retirement accounts first, then IRA account or traditional IRA, and then Roth IRA, saving that for last. But you got to be working with your certified financial planner. There are times when you deviate from those rules of thumb. Good question. We've got more coming up here on the Wise Money Show with Korhorn Financial Group. You ready?
Okay, so what's next?
How about a question here from Joel, 72, still working. Should I be doing Roth conversions? Let's start with that one. And let me pick another one. There's one from John right above that we can hit as well. I've got $500,000 saved up. Should I just exclusively contribute to my Roth over the next 6 to 8 years before I retire? Good. Third segment. Here we go. Does it make sense to be doing Roth conversions later in life? Maybe middle of your 70s even. We've got that question we're hitting right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KF2 studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, just search the Wise Money Show. Subscribe to it there. Rate the program there as well. We appreciate it. You can share it from there also. All right. Hitting questions from fans of the show. The next one coming up, we've got from Joel. Here's what he said. I'm age 72, but I'm still working. Most of my assets are IRA, but I've got a little bit in a Roth IRA. Should I be doing some Roth conversions now or wait until I retire in a year or two? There's some depth to this question that I'm not sure Joel's even aware of. So age 72 and still working. Well, they just moved the required minimum distribution age to age 73. So you are not yet at the point, even though you're still working, you're not yet at the point where you're forced to draw money out of your IRA. Quick tangent. If you're still working after age 73, do you need to take RMD from your 401k?
No, sir.
No, you do not. That's one of the ways that you can delay your RMD, but you would need to take your RMD on IRAs. Here's the deal, though. If he delays doing Roth conversions for a year or two, once he retires, you've got that benefit because now your income's lower, but you are now subject to required minimum distributions. Can you do a Roth conversion of your required minimum distributions?
No, sir.
But by doing Roth conversions, does it mean, or excuse me, but by doing an RMD, does that mean, no, you just should never do a Roth conversion? That's not true either. So there's a lot of depth here. Guys, how would you weigh in?
Well, to me, the question of a Roth conversion is always as simple as saying, well, does it make sense from a tax planning standpoint, first and foremost? Like, have you run a tax projection to figure out, am I, by doing this Roth conversion, by doing this proactive move in my financial life, am I going to trigger any kind of unintended consequences or unforeseen tax implications? And one of the potential unforeseen issues could end up being related to IRMAA. Mm-hmm. And IRMAA, if this is an acronym, IRMAA, it stands for Income Related Monthly Adjustment Amount. All it means is it's essentially means testing for Medicare premiums that you would pay. If you have big income, the government will expect you to pay more for your Medicare.
It is mean. Absolutely. Yeah.
The issue here is,
but you get a better Medicare policy.
That's right. That's right.
Right.
There's less weight. There's
no upgrade here. You just pay more for the exact same thing. And that could be something that you never even see yourself stepping into, because you may say, well, I don't have big income. Why would I have to pay more than my fair share here? Well, you could artificially make yourself appear to have bigger income just by converting too much money out of that IRA into the Roth IRA, because that maneuver, that move from one account to the other, adds income to your tax return that year. And if you add too much, it may take what would have otherwise been a great idea and suddenly make it a mistake.
Well, but there's another idea as well.
Yeah, I mean, Josh is going, that wasn't where my mind went immediately. My mind went immediately to, wait a minute, I might not be paying taxes on my Social Security,
yep.
Mm-hmm.
or I might be paying taxes on little of my Social Security,
yep.
and I pull $1 out of my IRA to convert it to a Roth IRA. So my traditional IRA money gets converted to my Roth IRA. That dollar brings 85 cents of Social Security with it. So I'm paying taxes on $1.85. Now, could that make sense? It could. But again, this is incredibly, incredibly complex, because you really want to thread the needle here. And because why does a 72-year-old work? Because they want to, or because they have to. Mm-hmm. And so I know lots of folks that are 72 and aren't even working for a paycheck, but they work just as hard at 72 as they did at 52.
Yeah. Yeah.
So whatever your situation is, you want to understand what is the taxation of these dollars. And then I wouldn't even look, I mean, Joel, I would look at a 20-year tax projection to say, how are these various pools of retirement assets going to be taxed over your lifetime? But also, how are they going to be taxed over the beneficiary's lifetime? Because that's the question, who should pay taxes on these? And Joel, if you're married, you can get a lot more money out or free of taxes or after taxes than if you're single. Mm-hmm. So this is where, if you're married and you're healthy, then you want to be taking advantage of this time while you have it.
I think in years to come, there's going to be more and more people in their 70s still working.
Yep.
And that could be part-time for fun, mostly, mm-hmm. It gives them something to do. It could be people who are in their peak earning years, like they are an expert in their field and they're hanging on because they love what they do. They're still great at it, and they could have huge income potentially. And those are two very different story problems, right? Mm-hmm. So this is why the answer always points back to financial planning. Yeah. Right? Because financial planning is what takes rules of thumb, throws them out the window, and replaces it with careful, personalized approach that's based on your situation.
Tailored to your situation. I took the words right out of my mouth, because all of what we're saying, there's some caution. No, Joel, it might make sense because you're young. Convert the money now and have it start growing tax-free for you for the rest of your life and your kids' lives. You just got to do that in a calculated way. And so, great question, though. Great question. Next question here comes from John. Is similar theme here, guys, but 60 years old. I've got $500,000 in retirement savings. By the way, $100,000 of that $500,000 is in the Roth. Is this a good time to start putting all my new contributions into the Roth side of my 401k moving forward? By the grace of God, I'm in good health and tend to keep working for another 6 to 8 years. What do you think?
To me, it's the same question. What tax bracket are you in? Are you in a high income situation, and to put money into the traditional side of your retirement savings, is that going to save you some significant taxes? Is it more valuable to you because you're in a higher tax bracket? So to me, this begins with a conversation with your certified financial planner about your tax picture right now and what you expect it to be out there in retirement as well.
Yeah, I think all kinds of things when I look at this question. I mean, one of the things is a statistic that Joshua has often cited, which is people don't retire when they think they're going to retire. They retire sooner. I love John, that you're saying, hey, by the grace of God, I'm in good health and intend to work 6 to 8 years. That's great. You could work 16 to 18 years. We don't know. Mm-hmm. But it's in your 60s where you have that first health event, where you are in a position where you have to now take care of your aging parents. You have to take care of your children. There's all kinds of different things that happen that make it so that the plan that you had laid out doesn't unfold the way that you had hoped it would. So I think the right question is, what is your tax picture today? And should your contributions be going in pre-tax or Roth? And then once you figure that out, then you figure out, okay, well, when am I going to draw Social Security? John, I'm going to go out on a limb and say you're going to draw Social Security at 67. So if you're drawing at full retirement age of 67, then you can convert more money without paying tax on your Social Security. Mm-hmm. So you might want to do that, or you might say, hey, I've got $500,000 in there. I'm going to work for 6 to 8 more years. That $500,000, good Lord willing, the creek don't rise, with contributions should be at $1 million or more by the time you're 66 or 68. Mm-hmm. And you might say, I've got $1 million, 100 of it is Roth, 900 of it I've never paid any taxes on, but that might not be a problem.
Yeah.
Depending on your income sources in retirement, and in this next 6 to 8 years, depending on what you do to your balance sheet. Because this is the time to just absolutely put the wood to it as far as how do I get my balance sheet so my income demands are minimal in retirement.
So, I mean, the answer is financial planning. I mean,
that really is the answer.
You left off on present financial position, so make sure that you've got the right foundation, the right cash flow plan, the right financial habits, and you've got to tune into your tax plan as well, your investment plan. I thought first of retirement plan, John. Before I would do anything, I'd build out that 5-factor retirement plan, and then go over to tax planning and build out that multi-year tax projection, stretching out 20 years or so. So, great question. We've got more coming up on the Wise Money Show with Korhorn Financial Group. Good.
Okay.
I'm saying
those are great financial planning questions.
They are. Mm-hmm. Yeah. I'm saying probably. Is there any more meat on the bones there?
No.
Let's go for variety.
All right. So, well,
I've heard it's the spice of life. Isn't that a funny saying? The spice of life. I thought Lowry's would have been declared the spice of life. Okay.
Okay, so I'm by diversification or variety.
Yeah. So I'm going to keep talking.
I'm going to go down
dead air here. The poor folks that are listening and watching, saying, "What are those guys doing?"
I have done a lot of videos, and so I'm not concerned about dead air. It's all. Sorry.
Okay.
So we'll go with the last one.
Okay. The last question?
Yes.
Okay. Let's
and
go.
And then we'll go back up since there's some similar ones here. So, all right, here we go. 4th segment, land and plane. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Make sure you check out the YouTube channel for the Wise Money Show on YouTube, of course. So we've got every episode, every talk show that you're listening to right now is on the YouTube channel, as well as a lot of other content, well over 1,000 videos. So make sure you go to YouTube, search the Wise Money Show, subscribe to it there. Turn on notifications so you're made aware every time we drop new content. We're hitting questions from the show. Lots of those questions come on the YouTube channel. So we appreciate that. Go check it out. All right, next question comes from the YouTube. And so what happens if a non-spouse beneficiary to your IRA, what if they don't spend the entire inherited IRA within 10 years? What happens to the balance? Now, we just did a couple of shows, and we created a lot of other content on this as well, just following this ongoing saga from the IRS, stretching back 5 years now. 5 years.
That's crazy.
Secure Act 1.0. Basically, prior to the Secure Act 1.0, prior to 1/1 of 2020, when you inherited an IRA from someone that wasn't your spouse, so from an aunt, an uncle, a parent, then you were allowed to draw as much as you wanted, and you got to pay tax on it. But if you didn't need it, or I don't want to touch this money, the IRS said, well, you've got to withdraw at least a little bit, and so you could do a required minimum distribution over your life expectancy, so you could stretch that balance out throughout your entire life. The rules changed. If you're still inherited dollars from someone that passed away before 1/1 of 2020, you're still grandfathered into that old rule. But starting 1/1 of 2020, there's a new rule. It's a 10-year rule that, again, if you inherit money from someone that's not your spouse, now you've got 10 years to withdraw the money. And that's
Withdraw all the money.
Withdraw all the money. We'll get back to that question here in a minute. But we've been waiting on the IRS to say, well, do you also have to take a required distribution every single year? And at first, all financial professionals were like, certainly not. There's no way. Mm-hmm. And then in 2022, the IRS came out with a publication, an example, and said, you do. And the industry was sort of up in arms. And they just came out 2 months ago and said, no, that's official. Mm-hmm. You do have to take, if the person that passed away was already taking their required distributions, then you have to take a annual distribution as well. And the account needs to be emptied within 10 years. So what happens if you don't?
If you fail to take those distributions, then it's a 25% penalty for the amount you were supposed to take and didn't take each year. So that's that annual amount that you have to pull out over the 10-year period. If you realize, I made a mistake here, I had an oversight, and you can get that fixed within a couple years, then they'll drop the penalty to 10%. Mm-hmm. But if you get to the end of the 10-year period and you haven't completely cleaned the account out as you're supposed to, is that where the 50% penalty still applies? That's what it always used to be. That if you failed to do required minimum distributions, it used to be a 50% penalty. And I think they've left the same kind of teeth in place here because they mean business, right? They don't want these accounts to be trailing out past 10 years because you weren't paying attention or you were trying to see if you could not be noticed, that kind of thing.
Yeah. So, and 10 years is a long time. Yeah. I mean, you might lose track of time. What did I eat for dinner yesterday? I forgot. But when you inherited dollars from someone, especially if it's an emotional and painful memory, you don't want to be anchored to, okay, well, wait a second. When did mom die? When was that again? What year was that? And so, but there are penalties, and therefore you want to know. Now, that doesn't mean, oh gosh, I'm not going to remember this. Let me just take it all out in year one and pay the taxes. You want to strategize, but you want to take it out within those 10 years.
This is one reason to not necessarily wait until the last second to get this account closed out as well, because what if in that 10th year, when you were planning on doing most of the distribution and paying most of the tax, and something dramatic changes in your financial life? Something else happens that causes your income to spike that year, and now all these dollars coming out of the IRA cause it to spike on top of a spike.
Yeah.
Man, the tax implications could be lasting, could be pretty pretty significant. And so it's part of the reason why we're always talking about these multi-year tax projections, where you're looking at a 10-year period or longer and saying, okay, strategically, where would the most ideal place be to pull money out of this account and pay as little tax as possible? And it may be lumpy. There might be some years that you have stuff going on and it would be let's take as little as possible. There may be other years where the rest of your income picture is just low, and so you have more room to pull additional dollars out of the IRA, satisfy that 10-year rule, and not trigger a high tax year at the same time.
Now, say that you have, so if you were following along and say you heard that, the IRS just finalized this rule. Well, does that mean you now have 10 years from the time that they finalized this rule? If you inherited money from, mom or dad, and when they passed away in 2021, and you weren't sure what the rules were, now the IRS says these are the new rules. They start in 2025. Do you not have to withdraw the account by 2035?
No, unfortunately. It was the day when your parents or whoever passed away and left this IRA to you. That's what started the 10-year clock ticking.
Yep.
That's the 10-year window that you have. We've just been waiting to know exactly what the rules were going to be along the way. The 10-year time frame has never been changed.
Yep, that's right. So you want to be aware of it. And again, going back to, this could be a painful memory, and, life is slippery. So, how much attention do you pay to this? Work with your certified financial planner. They're not only going to be the one strategizing with, so one of the mistakes we see a lot of people make with this is, I inherited money from mom and dad. They must have had it invested a certain way for a reason. I can't change it. I shouldn't change it. I'm not going to make any, you're sort of paralyzed because you don't want to make a mistake. This was their money. I don't want to make a mistake with it. But now your CFP is going to help you overcome those feelings and with a wise approach, look at these dollars in connection to the rest of your portfolio and the time horizon and all of that, and help you determine how to invest them, what role they play in your retirement plan or your financial goals, when is best to withdraw them, whether it's just a required minimum distribution and take a little bit more or whatever, like Josh was mentioning. And they're also going to keep track of that 10 years for you. They will. So, once again, it sort of goes back to financial planning. Mm-hmm. So, all right, last question here we'll tackle comes from Donna. I'm 71, so my required minimum distribution starts at 73. Is there something that I can be doing, even at this late stage, to reduce the taxes that I'm going to owe on my RMD? I know I should have started sooner, but I'm hoping there's still something I can do right now.
Well, whatever amount you pull out of your IRA is going to be treated as income to you. And so to me, the way that you have an impact or do something proactive in your financial life to reduce the tax implications, it's reduce the amount of required minimum distributions themselves. And one way to do that is to move the money from an IRA to a Roth IRA before that date comes, before you hit age 73. So you've got a window of time, a couple of years here, where you could be moving money from the IRA to the Roth. That's called a Roth conversion. It creates tax for you in the meantime. Like, you're going to pay taxes on the money that makes that transition. But once the money's into the Roth IRA, it no longer is subject to those same required minimum distributions. So you've effectively kind of diffuse some of the ticking time bomb related to that IRA. You've reduced the amount that goes into the calculation when we're figuring out what is that required amount that you have to pull out each year.
I think of a couple of things that you could do. If Donna, if you're single, get married. Because that reduces the tax. Another thing that you could do, because Josh, as you were painting that picture, all I could think of was playing Sorry with my kids. And you want to get your little man. You have 4 of them. You want to get them into basically home base.
Position,
the home position. And so we're talking. This conversion is getting things to the home position. But the other thing, and I know you'd like it back here, Mike, but just work with me here. The other thing that you could do is do charitable
Qualified charitable distribution.
You got
it. Because that doesn't start at 73. It starts at 70 and a half. So that's a strategy you should consider.
And reduces the taxes.
There you go. All right. Good question, though, Donna. Absolutely work with your CFP on that. Explore those strategies and more. That's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.